Forget to record it.
Okay, so welcome everybody. Today's session is on taxes and real estate. Initially, the agenda was to talk from a perspective of a real estate agent and about the personal real estate corps, and then we decided to kind of widen the agenda a bit. So we definitely want to talk to that issue of the personal real estate corps to see Neal, Gerry, what you guys are seeing out there. Are people, real estate agents getting their corporations set up? How are they using their corporations? But we've widened the agenda so we can, and it should be an interactive session. So we appreciate anybody who asks questions. We even had a couple questions sent in. One question was sent in. I shared it with Neal and Gerry last week just to give them an idea, and they both wrote like a full page report for this woman who inquired. So amazing value, I believe, and appreciate both Neal and Gerry for taking the time out at this busy time to help to educate. So let's start off with Neal, because Neal is new to our network and to some of our programming. Neal, you wrote the book, The Grumpy Accountant. We see it there on your shelf, right? I think below the picture of Kramer. Tell us about the Grumpy Accountant and about yourself and why you started realtytax.ca.
Sure. So the Grumpy Accountant, after I started my own practice 8 years ago, at first it was very exciting. And I think I was a little naive and it was like, oh, this is great. And then a few years later, I started to become very frustrated with all the bureaucracy that we have to deal with, all the inefficiency in our tax system. And I started to complain a lot to my wife. Every day after work, I would complain to her. And eventually she said, okay, enough. I don't want to hear it anymore. But she suggested why don't you write a blog, an article or something, and you, you try to spread the word if you really feel strongly this way. So I opened a Microsoft Word document and I started to write my ideas of how to simplify the system. I started to write down all the ridiculous stories that were happening to me and dealing with CRA and all these issues. And I started to realize, wait a minute, this isn't just a few articles here. I could write a whole book about this. So that's how the project started. And then, the title came to me because I was once at a family dinner and I was complaining, like every family get together, I start complaining about everything that I think is wrong with society. And my mother stopped me and she said, Neal, you sound like a grumpy old man. And that word grumpy it stuck with me. And I knew I would put it to good use one day. So that's where the Grumpy Accountant came from. The book has there's two parts to it, but it's in one book, which the book reads like a novel. It's like a story, like The Wealthy Barber. I copied his idea, Dave Chilton, and I actually spoke to him about it, got his permission and blessing. But there's two parts to it. One part is just trying to educate Canadians about the tax system. So it's really not for people who need advice or tips on very advanced tax planning. The advice is simple. There's 29 tax tips, but the feedback I've received is that it serves as a great introduction to the Canadian tax system. So anyone in grade 12 and college university age should really read the book, so people can buy it as a gift for their high school kids or college university, because it's a great intro to the tax system. But the other part of the book is my ideas on how to massively simplify the tax system, so that really my job and maybe Gerry's job to an extent shouldn't even be necessary. Like, what are we doing? So that's the idea of the Grumpy Accountant.
Okay, and what about realtytax.ca? Where did that come from? That's a relatively new company you started,
We
correct?
we started that last year. My business partner, Stephen Pitucci, who is in on this meeting, he's joining us. So it was his idea. He started it and he brought me in as a partner because he knew it'd be a lot of work for just one accountant. So we started this firm which specializes um, in Ontario real estate agents. So the only clients we take in are realtors in Ontario, and obviously their spouses, like we do the whole family's tax returns. The idea is that we help them with their incorporation of their personal real estate corporation. And we also do all their bookkeeping. So we're not just doing the year-end taxes, we do in QuickBooks Online, paperless, cloud-based bookkeeping throughout the year as well. So it's a one-stop shop for realtors. And we serve realtors whether they're incorporated or they're self-employed. So some realtors may not need to incorporate for all sorts of reasons. So we provide service to them as well.
Okay, very good. Thanks, Neal. Gerry, you have a lot of experience as an accountant. I think more than 2 decades. I think at this point in time, you started off at Deloitte Touche, and eventually you got into your own practice and started focusing, working a lot with real estate investors. At this time, you work with real estate investors and with a lot of real estate agents. Why does real estate interest you so much? And and tell us a little bit about Canadian Investment Services, which I know is a big part of your activities these days, please.
Yeah, thank you, David. Thanks for having me, David, and welcome everyone. So yes, I think I'm into my fourth decade actually. So I did start out with Deloitte Touche, worked in their tax department, then set up my own practice. It's interesting you mentioned what sparked my interest in real estate. I learned at an early age the benefits of passive income, and I learned that from working at Deloitte Touche, where it was literally a sweatshop. I mean, it was insane. Neal, you know what I'm talking about. I mean, when you're an articling student in one of these big firms, they just, I mean, you got to put in the hours. Anyway, so, I wasn't against hard work. I was all for it. It's a great learning experience. But, at some point you realize, wow, there's got to be a better way. So I certainly was introduced to the concept of passive income. I was lucky enough to start buying a few rental properties, and everything worked well. The whole, back then it was, you buy a house, you put 90% financing, put 10% of your own money into it. The rent covers all the costs, and the house goes up in value. I mean, that worked beautifully. And so really, as a public accountant, I felt that I was really restricted in the value I could provide to my client. I found I was, just as a public accountant, I was more compliance driven, just making sure these tax returns get filed on time, without really providing better and more value to the client. So certainly by expanding into the investment world, I believe I'm able to provide a little better value for my clients, along with the tax. I mean, our goal as accountants is to minimize the tax that people pay within the parameters of the, what is it, Neal, 3,000 page income tax act or something like that.
Yeah, over 3,000. Yeah.
So anyway, so that's plus it's just passion. Just I've always liked real estate. I think it's from an investment strategy. It's easy to understand. It's not overly complicated. The fundamentals of real estate. So I do find it an interest. And plus, I've also been in the investment industry, and I say this not to be boastful, but just to lend credibility, that I've actually, I think I'm the only Canadian that's held every investment license out there as a CPA. And so I've seen it from the inside, and I'm very critical of the whole investment industry, how investment advice is provided. I just don't see the overall industry providing a lot of real estate related investment opportunities for investors, and that seems to be the preferred area for most investors. And through the traditional financial or investment channels, that's really not as available as it should be for people. So that's kind of how I landed there, and here I am today.
Okay, very good. So we'll talk more about real estate investment within the context of personal real estate corps and just in general. Neal, what are you finding with regard to real estate agents and the personal real estate corps? How, from your perspective, how does a real estate agent know if they should be setting up a corporation, and are they taking action?
Yeah, so it's definitely the most common question we've received from all the people who inquire, who email us and reach out to us is, should I incorporate or not? It's the number one question that's on every agent's mind. So I think like we have received a lot of inquiries from people it's definitely on the radar. Like I think most realtors now in Ontario are aware of this, that they are allowed to incorporate. Um, and I think they are taking action. Like they're Googling, like we know that some of our realtors are finding us on Google or Facebook. Um, and we've done some webinars for some of the brokerages where they have all their agents come and we explain to them what the PREC is and the tax benefits, implications, and pros and cons. And um, so I think they are taking action. It's the most common question we get. Um, and many of them end up incorporating I mean, there's really no other way to do it other than having a meeting with the realtor and asking them a whole bunch of questions, getting to try to know, to really understand their whole tax, personal finance situation, them and their whole family, to determine whether they should incorporate or not. There's like a lot of realtors will ask us this question: what level of income do I need to earn to make it beneficial to incorporate? And that's not really the right question. We need to know, well, okay, what's your level of income, but how much of that do you need every year for personal use? Like, there's a whole bunch of questions that that affect the decision. So we have to set up like individual consultations with every single realtor to determine whether they should incorporate or not. But I think generally, like this is on every real estate agent is I think they're all aware of this now. I imagine because the legislation took effect October 1st last year, 2020. So I think by now most of them are aware of it and they're looking into it. And it's definitely the most common question that we get.
Okay, so no hard and fast rule. Depends on the situation from your point of view. Gerry, what are your thoughts? Are there any rules that can be applied? How does a realtor know if they should be setting up a corp or not?
Yeah, well, as Neal says, it's a topic many realtors are approaching accountants to discuss. So I'm somebody that really I think most realtors benefit from a PREC. Um, realtors need to look at it that they're filtering their income right now up until October 1st. I mean, they filter their income through their personal tax return. And in simplified form, you got four different, you got a 20% level, a 30%, a 40%, and a 50% bracket. So that income gets filtered through that. So to filter that income through a corporation where we can pay 12.5%, certainly, that's not the be all end all, but it certainly creates some advantages. But as Neal says, it really depends. The real benefit of a PREC is if you have excess income, if you earn income that you don't need to use personally. Now, all of a sudden, all the math starts to work a little better. But there's even certain advantages for agents that may not be the high producers. There's still some benefits. For example, you can flow income through a PREC, pay yourself a dividend, which we can talk about a bit later, and pay, and avoid paying Canada pension on earnings that you have earned. So that's an area worth discussing. That's a big savings now. So there's many different components to it. I find real estate agents, certainly, as Neal says, they're aware of it. They're interested. They need information. I think a lot of it applies, to each individual situation. But more and more, I think overall, I think most of the real estate agents would benefit. Accountants look at the PRECs from a tax perspective. I also add the investment perspective to a PREC. There is many investment-related benefits to flowing your income through a corporation, aside from the tax benefits. So certainly, again, the majority of them will benefit from it. Certainly worth discussions. You also have to do a cost benefit analysis. I mean, there's an extra layer of cost when we set up a corporation. So, we want to make sure that the benefits exceed the cost. And I also think a PREC, in our practice, we use PRECs now for real, a retirement a tool, a financial planning tool, a retirement planning tool, and estate planning tool. And there's, again, so many benefits when you add a corporation. It's just another tool that we as accountants have, whether we're trying to save tax or whether we're trying to optimize investment opportunities. It just gives us another tool.
Gerry, I'd like to talk. We can talk more about it later, but high level, the benefit of investing through a PREC or a corporation. What is the benefit?
Well, the main benefit is, again, a corporation has a 12.2% tax rate, call it 12 and a half. So through a corporation, we're earning 87 and a half cent dollars. So we're keeping those dollars. So there's one benefit, that we're retaining more money to use within the corp to do whatever investing we want. I'm somebody, this is another topic, but I'm somebody that's very critical of the use of traditional RSPs in somebody's financial planning and investment world. To me, your PREC becomes your RSP, and there's much better advantages to flowing that income through it. So the answer to your question is as much a tax-driven question. We just retain more money. So it's not that we can do more in a corp that we couldn't do personally. Basically, any investment opportunity is available in a corp that you can do personally. It's just the implications of that investment and how it filters through your tax system, your financial planning, your retirement planning, and eventually your estate. Okay, with a corporation, there's many estate planning benefits, certainly compared to an RSP. I'm somebody who's done, God, way too many final death tax returns where I'm the one stuck saying to the beneficiaries, oh, sorry about your parents. They've left you $500,000 from RSPs. And unfortunately, we have to send $250,000 of that to CRA. People don't even realize this stuff, and proper planning could have prevented so much of that over people's lifetimes. So once again, I go back to saying that a PREC or a corporation in general is just another tool that we have when we look at the entire picture of somebody's plan. So.
Okay, very good. So we've got some questions coming in. As I mentioned earlier, we also have a couple questions that were sent to us, but let's just go through the questions. Lori is asking, at which point would you suggest that an incorporated team become a brokerage? Neal, do you have any comment on that, or?
Well, for real estate agents, the rule with the precs is that each prec, if you're a registered realtor and you want to open up your prec, you must be the shareholder of your prec. Now you can make spouses or certain relatives like non-voting shareholders, but only one realtor per prec. That's basically the rule. So if you're operating through a team, let's say you have 4 real estate agents that want to operate as a team, each real estate agent still needs their own prec. You can't have one prec with 4 realtors as 25% shareholders. That's not how it works. So you could have a team that works together, but each realtor would still have their own prec. I'm not sure if that answers the question, but I just wanted to clarify that because the RICO regulations are very clear on that each prec has to be owned by one realtor.
Okay, gotcha. Gerry, do you have any comment on that question?
Yeah, I don't think the issue of PREC really has any implication to that question. The decision for a number of realtors to create a brokerage, the PREC really doesn't belong in that discussion.
Okay.
As Neal says, the PRECs have to be owned individually by the realtors, at least the voting shares. So really, it would almost maybe even be a disadvantage for everybody to go together under one umbrella and negate the benefits of flowing your realtor income through a PREC. So,
and yeah, my partner Steven just put in the chat that actually the brokerages have a lot more regulations from RICO and administration that they have to do, right? Brokerages have to keep a trust account. They have to do trust reconciliations. There's all sorts of administrative complexity with the brokerage. And that's really one of the advantages of the PREC. It's much more simple for a realtor to run their own PREC. So that's something to consider.
Yeah, I know from a mortgage standpoint, the idea of having a team versus being part of a brokerage is the brokerage requires different insurance and has different compliance requirements. Outside of the tax vein, but interesting question. Thanks, Lori. We have a question from Marino. He says, Neal, what percentage of realtors that you have conducted a discovery have actually incorporated?
Well, when the realtors first come to us, usually they haven't incorporated. They're coming us to see if they should incorporate it. And I would say most people we end up concluding, and Gerry was alluding to this, for most of the agents, it makes sense to incorporate. There's a few that it doesn't justify right now, or they're just starting out. They just finished school at They just finished the program at Humber, or they're doing it part-time. Although sometimes for part-time agents, it actually makes a lot of sense to incorporate because they have a full-time income from their employment income and they don't need any of the commission income. So those people, actually does make sense. But anyways, I would say the percentage wise, I don't know exactly, but it's a lot. I mean, it's definitely the majority of people end up realizing the benefits of incorporation, and we usually recommend it. But I wouldn't say it's 100%, but it's a lot.
Okay, very good. A question from Marino. Gerry and Neal, what are your position on RRSPs? Are there other vehicles that make sense? Okay, well, I mean, we've heard from Gerry on that. I mean, he can say more, but why don't we see Neal, what are your thoughts on RRSPs?
So first of all, I want to answer the second question first. Are there other vehicles? I still love the TFSA. Um, I think the TFSA is great. I think it's a no-brainer. I'm curious to hear what Gerry has to say about it also. But in terms of RRSPs, I agree with Gerry in terms of you don't want to die with a big RSP, right? Because you'll basically pay half of it to the government. Nobody wants to do that. So people need to plan for that. But I still think RSPs could be beneficial. A few weeks ago, Jamie Gollenbeck wrote an article in the Financial Post about this exact issue. And they released from I think he's at CIBC, right? And he released a whole report where he ran the numbers for business owners. I think he released a free ebook, and his conclusion was that actually RSPs could still make sense for small business owners. Um, it doesn't mean it's for everyone, and I understand that there's other opinions out there, but I think it's still something that people may want to consider. Maybe they could benefit from spousal RSPs. I mean, there's certain things, but generally speaking, I agree with Gerry that the PREC is an amazing tool, and people should, if they're able to leave money in their PREC, because of that 12.2% rate, that's the lowest tax rate that we'll ever have. I remember once dealing with a client that has a US accountant to do their US returns in the US. And I was coordinating with this US accountant. And when I was telling him about this small business tax rate, 12.2%, and the active business income, small business corporations, he couldn't believe it. He said 12.2%. Oh my God, they don't have anything like that in the US in terms of like corporate tax. So it's definitely beneficial to keep money in the PREC as much as possible. But some people still might benefit from RSPs. Again, it really depends on the situation, I think.
I guess if you can get the money out before you die, the theory being that the money comes out at a time in your life when you're in a lower income bracket. So if you can actually execute, there may be some upside. Gerry, TFSAs, you like TFSAs, Gerry?
Yeah, absolutely. I just want to chime into that RSP discussion because I don't want to come across as somebody that completely dislikes RSPs. What I'm very critical of is how RSPs are promoted. Okay, the investment community promotes RSPs simply because they want assets under management. They don't go into the whole financial planning and the logic of whether you should. I'm somebody who says, yes, RSPs can play a role in somebody's financial planning world. And in simple terms, just think of it this way. When you put money into an RSP, you get a tax deduction. When you take money out of an RSP, you're paying tax, okay? Very simple logic. Now, if you're putting money into an RSP and saving 50% tax, and you're pulling it out and paying 20% tax, I would do that all day long. But I've seen so many people put money into an RSP and save 20% tax, and then pull it out and pay 30, 40, 50% tax. And I'm just shaking my head. I'm going, why did you do this? And I don't know. The bank told me to put money into their mutual fund. Yeah. So again, I just want to be clear. I know I always become critical with RSPs. I just really become critical in the way they're used. So yes, there's many benefits. The other way I kind of explain it is we will all probably be in a minimum 20% tax bracket all our lives. From now till the day we die, we're going to be in a minimum 20% tax bracket, which means all our money in our RSP is going to be minimally taxed at 20%. And heaven forbid, when we die, if there's too much money in there, we're going to send half of it away. So I'm a real advocate for what I call RSP meltdowns. So I like getting people's money out of their RSPs if we can get it out at 20%. Now, here's just a simple example using the PREC analogy. Let's just say a real estate agent made whatever amount of money. They put it in the PREC. They pay their 12.5%. They do not take one penny out. And then they pull out $50,000 out of their RSP. Okay, we've pulled that money out of the RSP at 20% now. Okay, so that makes, to me, a lot of sense. We're going to pay 20% anyway in our life. We might as well get it out. Yes, there's going to be people who go, oh, you're prepaying the tax. You shouldn't be doing that. But again, over time, that logic to me makes a lot of sense. Now, you asked me about TFSAs. I love TFSAs. I mean, hey, especially for the aggressive investor. So when I talk about investments, I try to, I don't want to go deep down this rabbit hole, but I think the whole investment industry has it backwards. They put the rate of return ahead of protection of capital. I try to protect capital first, which we can do with real estate, and then get a rate of return. Now, when I manage money, people go, well, I still want to keep $10,000 aside and I want to, buy stock with it. I think Bitcoin, what is it now, $60,000? I mean, stuff like that. Anything with a significant upside certainly should be in a TFSA, because if you hit the home run with that investment, you're not paying any tax on this stuff. So I like using TFSAs. There's really not much reason not to optimize using TFSAs, but I certainly strategize with the client that if they're looking to, play the stock market, which I call casino-rama gambling, if you hit the home run, you want that home run in your TFSA because you're not paying any tax on it. So again, TFSA is a very good thing. Certainly another tool that we utilize in the overall view of financial planning and investment management. So yeah, I like them.
Okay,
I just want to,
yeah.
can I just add one point? And I agree with everything Gerry said. And the other point I want to add, one of the downsides of the RSP, and I like Gerry's idea of the RSP meltdown, because once somebody turns 71, I think the year after you turn 71, you start to have these fixed percentages that must be withdrawn from the RSP every year that the government sets. And these percentages have been set like decades ago. They've been modified recently to reflect like people live a lot longer now, right? So in that sense, they're very inflexible. Whereas with the PREC, if you're using a PREC as like kind of like another RSP account in a way, like another retirement tool, you have that complete flexibility when to take the money out, and you could smooth out your income. So that's one of the disadvantages of RSP. And I agree with Gerry, like proper planning has to be done, like to try to avoid those fixed withdrawals at very high tax rates in that once you reach that age.
I'd love to jump in on what Neal said, because it's so true. Filtering income channeling income through a PREC, we have control and flexibility. As Neal says, when we go into the RSP at age after 71, the government mandates that we take money out. Now, I want to use an example. So my mother, okay, so she gets her Canada pension, her old age security, and she gets a little bit of income from her RSP. And that little bit of income puts her high enough, even though she makes very little money, but that RSP withdrawal that is mandated puts her high enough that she cannot qualify for the guaranteed income supplement, which is just an extra income to low income senior citizens. So it's frustrating as anything to see that, she was told to put money into an RSP. She never did listen to my advice. So I always say that to her, to not have put money into an RSP. Anyway, she goes to the bank, puts money into RSPs. Now she's well over 70, getting this little drib drab of RIF into her income tax return, which denies her guaranteed income supplement. And I get to stand back and say, told you, mother, you didn't listen to me. So anyway, once again, it's just another planning tool. So flexibility is the key. Through the PRECs, we control. We have ultimate control when that income hits a tax return, when we do whatever we do with that income. With an RSP, we do not. We lose a lot of control with that.
Okay, lots of questions coming in. Somebody has sent me a private one. I am also a flipper. So he's a real estate agent and he's also a flipper. Can I put this income into the PREC?
Me, 100%. Depends where the project is being held. So, as you know, David, I do fix and flips too within our company, and it depends how it's structured. So I do a lot with joint ventures, and 100% we want that income. A fix and flip is active business income, so it qualifies for the 12.2% as long as it's structured properly. So I always make sure that we create we have a corporation as an entity within the joint venture that we can channel income through. So to answer the question, yes, you can use your PREC to pay tax on flipping income, but it has to be structured properly.
Neal, you agree with that?
Yeah, my question, Gerry, we've kind of looked at the RICO regulations, and they have this weird thing that says, it's very like worded very vaguely, and they say the PREC should not be used for I think they call it like trading and real estate, or anything other than trading and real estate. I forget the exact wording, but basically implying that flipping itself shouldn't necessarily be done directly in the PREC, and maybe through a holdco, like a separate corporation. Or are you like, I'm curious to hear your thoughts on that.
Yeah, I've read all those regulations, and Neal, like the income tax, they're half of it is black and white, half of it is gray, subject to interpretation.
Right.
RICO is similar.
Yeah.
So the PREC, the one thing you cannot do with a PREC is use your PREC to market yourself as somebody who buys and sells real estate as a licensed agent. So that's certainly a no-no. Other than that, there are some restrictions. It's not clearly defined that we can't use that PREC to participate in those type of activities, as long as it's not perceived that the broker, or the agent, is involved, and the PREC is representing them as buying and selling. So it's my understanding that we're okay channeling the fix and flip income through a PREC. Again, it is an area subject to interpretation. So if the power is to be interpreted differently, then then we could have a problem. So
yeah.
Okay, very good. Raj asks, and let's start with Neal on this one. What can we do with the money saved via lower tax rates?
Yeah, so within the PREC, like Gerry was saying, that low 12.2% tax rate, all of a sudden after tax, like personally, instead of paying 53%, if you're in the highest bracket, you're now only paying 12.2. So now you have all this extra leftover money within the PREC. You can invest it within the PREC. You could have a savings account, a self-directed trading investment account, or you can invest in rental properties. It's up to you, really. I mean, as long as you don't withdraw it for your personal use, because then if you withdraw for personal use, well, then, we have to show that as personal income, and then you pay the personal tax. But on the corporate level, you could invest it, save it, rental properties. So there's a lot you can do, really. And that's really the main advantage of the PREC. Like Gerry was saying before, that low tax rate gives you more money retained in the PREC to then invest. So you have more principal that you're starting with, and which in 2017 the federal government passed some of the most horrible, complicated, insane punitive legislation called TOSI, tax on split income. But one of the some of the proposals in that legislation were to actually kind of remove some of these advantages of these small business corporations, because they know that incorporated business owners have this advantage with this low tax rate. They now have a bigger pile of money to invest compared to, let's say, an employee who's getting a T4 and has to pay all the personal tax up front. So they try to come after some of this kind of advantage. And I saw Gerry shaking his head. I'm sure he also thinks that the legislation was crazy and punitive as well. God. But for now, we still have this 12.2% tax rate, and it's very advantageous.
Thanks, Neal. Gerry, what about you? Can you help Raj out? He's got all this leftover money in the PREC.
Yeah, the whole key is we're just retaining more money. So we're basically, if we didn't have a PREC, we're sending way too much money to CRA. So we're actually inside of a PREC, we get to play with CRA's money. So we retain a lot more of it. And again, for those real estate agents that, are do reasonably well and above, certainly the large producers. I mean, there's just so much money to be saved here. So yeah, it's just a matter that we have more money to play with. Again, I'll repeat myself, all that extra money inside of a PREP, we utilize to implement investment strategies, retirement planning. We just have so much more leftover money. So that's the whole key. The whole key, I think it was Neal said at the beginning, is if you earn more money than you need to use personally. So if you're earning a lot of money, I mean, you figure out, most people, if you really budget properly, you don't need a whole bunch of money personally. I mean, you got to pay your mortgage, you got to pay whatever personal expenses, you got to eat, but some of these expenses are deductible in the PREC also. You get to claim your office and home, you get to claim your car. So, you figure it out, you don't really need as much personal expense as people think. So lots of residual income in the corp. And just, there's no rules to what we can do in there as far as, well, I shouldn't say no rules, but certainly limited, there's so much we can do inside of a PREC. Let me say
Okay.
that.
So Raj had another question, which we'll come back to if there's time, but I wanted to jump to this question from Lambros. I think it's important. 12.2% is only for active income. No, isn't passive income in the PREC taxed at over 50%? Gerry, you want to start with that one?
Right. Yes, exactly right. 12.2 is active. So we have to have a good definition of what is active income and what is passive income. So as far as the realtor income, that is active income. There's no problems with that. Okay. Now, passive income is yes, it's taxed at 50%. So we certainly try to structure things to avoid as much of that. There is what we call refundable dividend taxes. And there are ways that you get a tax benefit from paying some of that higher taxed income out personally. I don't want to get into the complexities of all that, but so passive income, when you do mortgage lending inside of a corporation, you're earning interest income. That's passive income. So we want to, minimize. So there's ways that we can minimize and even reduce and eliminate passive income inside of a corp. So that's just strategizing, but you're certainly right in your comment that passive income is taxed at 50%. I know myself, as most of the regular viewers know, I like real estate income trust. Let me qualify that: the right type of real estate income trusts. And these type of vehicles produce what we call return of capital, where you're receiving a distribution and it's not taxable, either personally or corporately. So strategies like that we can implement within a PREC. So again, your comment is correct. We strategize around that, either within the personal financial planning or corporate financial planning, or both.
Thanks, Gerry. Neal, comment on that?
Yeah, everything Gerry said, I agree with. I would just add, I just had a discussion yesterday with a client asking me about capital gains and asking if there's any difference in the capital gains tax rate, whether a capital gain was earned personally or in a PREC. And it's in the PREC, it's basically, when you think about it, 25%, because it's half of half, right? Half the gain is tax-free and you pay 50% on the taxable half. Now, so personally though, the capital gains tax rate you pay, it depends on all the other income. So in the corporation, it's flat. But personally, if you're in the highest tax bracket right now in Ontario, 53.4%, which is insane. But let's say you're in that bracket, you'll actually pay a higher rate of capital gains tax personally, because half of your gain will be taxed at 53.4% instead of in the corporation, which is I think 50.4 or 50.7. So in the corporation, it's actually a lower rate. So that's also important. People, when they plan, I'm going to buy an investment property, a rental property, and I know when I sell it, it will be a capital gain. It won't be business income because I'm holding it for, let's say, 10 years or something. It's important to kind of try to estimate, well, what level of personal income will you have? And that way you can determine, like, when you have the gain, whether it's beneficial to own that through personally or in the corporation. But of course, because of that 12.2 low percent rate, you have more money to invest. So usually you have more money within the corporation. You don't take the personal tax hit when you withdraw to buy another property. And that just, shows the power of the PREC.
Okay, there's a question here from Marino. I'm going to jump to this one. Gerry and Neal, do you discuss with people who have a personal real estate corp or other clients that are incorporated the use of corporate life insurance?
I'll just
Neal,
quickly,
go
if I
ahead.
had a client ask me about that, in realty tax for what we do, that's a bit beyond our what I like Gerry's business model because he also does the investment side of it. Whereas in realty tax, we don't do investment advice, we don't do wealth management, but we would probably refer our clients who want that to Gerry to get that set up. So I'll let Gerry take this one.
Thanks. Yeah. So 100%. So again, the PREC, I'll repeat myself that we talked about. We have more residual income in the PREC, assuming we're earning more income than we don't need to live. What we do with that residual income, as we've talked about so far, is in different investment options. When we do a larger look, when we do some financial planning. I've created my own little financial planning program on an Excel spreadsheet that really shows somebody's financial life from now till 80, 90, 100. And what that illustrates is, as we all invest in our assets grow, we have this tax ticking time bomb that exists in our lives. And it just, if our investments grow, if we do these financial projections and we go, hey, we're going to invest in this and we're going to make 5%, 8%, 10%, and we show that over a lifetime, this little ticking tax time bomb becomes reasonably large. And what I say to clients is we can do one of two things about that. One is nothing, that we just simply grow your assets. You're going to die one day. We deal with it in the estate. We need to liquidate assets to pay your tax bill. Or we create some insurance strategies. To deal with the tax liability on death. Now, the PREC can actually own a permanent life policy, okay, which is a very effective tool, especially if you're earning income. Again, we wouldn't have income in the PREC if you weren't earning more income than you need to live, than you need to use personally. So within a PREC, I'm a real advocate that we at least discuss the potential of utilizing a permanent life policy in the PREC, and that accomplishes a couple of things. One, it accomplishes the ticking tax time bomb that we all have to deal with. Well, we don't deal with it, but our loved ones end up dealing with it on our final tax return. And it also, it's a great strategy to create tax-free income as a retirement tool. So permanent life insurance is extremely misunderstood by so many people. It is an extremely valuable asset. It's actually an asset. It's an investment. People look at life insurance and think, oh my God, I don't want life insurance. Oh my God. But it's an asset within a corporation, within a PREC. It's an investment tool. And if structured properly, it's extremely effective to provide tax-free retirement income. It'll deal with the ticking tax time bomb that we all have in life, and it will leave a much bigger chunk of money, a bigger legacy to our loved ones. So it's a very underutilized tool. It's something that needs to be better understood. So yeah, I'm Marino. Thanks for the question. I'm a real proponent of at least exploring. Again, as I say, in general terms, people need to be aware that there's a ticking tax time bomb. They need to see it. I've created this little program that you just show one screen, boom, there's your financial life. If everything that we talk about today happens, as far as rates of return and what you're doing with your money, here's what's going to happen when you die at 80, 85, 90, 95, or 100. And again, there's two choices. One is do nothing, let your estate liquidate some assets. And that's not wrong. That's not the wrong answer. But you should be aware that this is there. Or again, one, you do nothing, liquidate assets to pay the final tax bill. Two, you strategize with a permanent insurance policy to deal with that tax liability, as well as create incredible growth, within within these, I love these par policies, these what's called participating, where you're actually getting dividends from the larger insurance companies to fund these accounts. So anyway, I don't want to do a deep dive, but it's certainly once again, it's a tool. It's another tool that we use to do a comprehensive look at people's lives. So we anyway.
Okay, very good. Thanks, guys. Question from Don. Are PRECs allowed tax-free rollovers into the PREC of investment property currently owned personally once PREC is set up? Neal, do you want to start on that one?
Well, it's allowed, but you might have some land transfer tax implications, right? So, but there is a way to defer the capital gain and transfer a personal property into the PREC. But I think when you do that, it might incur land transfer tax. So some people don't like doing that, but I'll let Gerry chime in here as well.
Sorry, David, repeat the question. Sorry,
The question is, are PRECs allowed tax-free rollovers into the PREC of investment property currently owned personally once the PREC is set up?
Technically, so a PREC is a separate legal entity, as we as individuals are. So when we transact between non-arm's length, so me owning a corporation and me transacting between that corporation, we have to do it at fair market value. So we do have some tax issues that we need to consider. We can utilize Section 85 of the Income Tax Act to do some tax-free transfers. I don't want to get into the complexities of all that, but there are some options available within that strategy. It's a question that I get asked a lot. Should a realtor now has a PREC? Should I transfer my existing rental properties into the PREC? In many cases, the answer is no. It's just not worth it to trigger the tax to either do or utilize Section 85. The key thing, what I always say is, when somebody owns a real estate a rental property personally, it's not so much the asset, the ownership of the house, it's the income it generates. So if that thing is generating net rental income, so you collect the rent, you pay the expenses, if you have net rental income, that net rental income is going to go on top of any other income you earn. So once again, we need to know the tax bracket that the person is in. I always break it down in simplistic terms. There's 20%, 30%, 40%, and 50%. If we're taking that net rent and putting it on top of 50% income, that doesn't make a whole lot of sense. What I use the PREC for is I convert it into in a lot of cases, I'll convert it into like a management type of a PREC, where if a person owns the rental property personally, if there is net rental income, we can use the PREC to charge a management fee to the person to bring the income, let's just hypothetically say, down to zero. I mean, that management fee has to be reasonable. Okay, that's an interpretive term in the Tax Act. It has to be reasonable, has to be justifiable. But we can literally, in a lot of cases, we can eliminate that net rental income that's supposed to go on a personal tax return. And if we can do that, the whole question about should I transfer all my real estate holdings into a corporation is much easier to answer. Also remember, if we do have net rental income, and if we do transfer those rental properties into the corporation, now we have net rental income in the corporation. That's passive income. That's 50% taxed. Okay, so that may not make a whole lot of sense to do that. The whole key in all this stuff is to try to use that 12.2% tax rate as effectively as we can. That's really the simplistic. So when you say, should I transfer my rental property into a corp, we need to know more information, okay, to properly answer that question. Because again, when I get asked that question, the first thing I'm trying to look at is how do we optimize that 12.2% tax rate. Oh, you're off, David.
Sorry about
David,
that.
You're off.
Yeah, I'm back. No? Okay. Can you hear me?
Yep,
Yeah.
you're good.
Okay. Okay, so this, I'm going to bring up a question. I think this is a good segue into a question that Sherry asked. She emailed the other day, and both Neal and Gerry commented. I'll ask Neal to comment this. And also I noticed Let's say hello to Stephen Patucci. That's your business partner, Neal,
Yeah.
from realtytax.ca. Welcome, Stephen. So Sherry asks, hi, I'm a licensed realtor. I have 2 rental properties, houses, in my personal name. Will incorporating help? May I pay myself a commission to manage the properties? Example, 15% of rent. And Stephen says, isn't the management fee generally restricted to 10% of the gross rent? Neal, do you want to comment on this?
I think Gerry explained it pretty well, actually, but I would just add again, um, I'd also factor in, even if you do a Section 85 rollover to transfer the properties into the corp and not have that capital gain right now, there still might be a land transfer tax that you have to pay. I'm not sure if there are ways of avoiding that or not. I forget. So that's something you have to look into as well.
I wonder if
Um,
it has to do with whether there's the size of the mortgage that's on the property on a non-arm's length transaction.
I can answer that.
Go ahead, Jer.
Okay, so basically, at least according to my lawyer, so when we transact non-arm's length, the land transfer tax is based on the mortgage amount, any outstanding mortgage. Now, with that said, the lawyer was, my lawyer friend was not quite as definitive as he should be. I didn't think. So he's basically saying, yeah, we'll base it on the mortgage amount. But if the land transfer tax people ever come and do an audit, they might want to charge land transfer tax on the fair market value. So he was very vague in his answer, but he seemed pretty confident that he, as the lawyer, is required to submit land transfer tax based on the mortgage amount of the property. So that's a little vague in the answer, but that was what I, because I've asked him many times. And for those that we have done that, that's exactly what we've done. We've just paid the land transfer tax on the mortgage amount. Knock on wood, so far haven't had any issues with that. And if there is no mortgage on a property, then we've transferred properties in with no land transfer tax.
Okay.
and
Question from Rick. I'm going to ask Neal
oh,
to
sorry.
comment. He
I
says, what did you want to say something more on that, Neal?
Yeah, I just wanted
Okay.
to say about transferring rental properties into the corp, if it's owned personally. And Gerry was, I think he said this as well, but like in that specific situation from that question, for example, let's say she has zero other personal income. Her only income is the net rental income from these properties, and she has no other personal income. And let's say the net income from each property is only, I don't know, let's say it's $10,000. Like, just so her total income is $20,000 every year. Well, then she's much better off leaving it personally. Let that rental income be taxed. If her total income is 20,000 a year, she's hardly paying any income tax. So, and then if she has a prec to earn all her commission income, she could leave the commission income there if she doesn't need it. So again, this question really depends on the person's personal tax bracket. If they're in a bracket that's lower than 50%, the rental income in the corp will be hit at 50%. And of course, there's ways of reducing that, paying a salary, management fee, or even declaring CCA, capital cost allowance depreciation. And I know then there will be recapture in the future. So that's a whole other issue you have to look into. But again, like these types of questions, it always depends on the person's situation, specific situation.
Okay, very good. Thank you, Neal. Here's another one I'm going to ask Neal to comment on. Rumors about real estate being taxed. I think that's what Rick is suggesting for the new budget on principal residence, I guess. Is that likely to happen? How are they going to pay off all the debt?
Okay, well, I believe that it's impossible to make any predictions about the future. Okay, so 2 years from now, no one would have imagined COVID and the world being turned upside down. So what will happen on April 19th when the journalist turned finance minister releases their budget? Who knows? There's rumors, principal residence tax. My opinion, if they try to implement a principal residence tax, I think Canadians, for the first time in Canadian history, would rebel as a country. Everyone would march on Ottawa with torches and pitchforks, and there would be a rebellion. I think people would not accept it. I think it would be political suicide for anyone to try it. But who knows what these people will do? I don't know. But I think if they did try to implement some sort of tax on a principal residence, on a capital gain on the principal residence, I think they would have to look at the US model, where in the US they tax your principal residence, but they have an exemption amount. So if your gain is 500,000, like for a family, or 250 per individual, the first 500,000 of the gain, if your family unit, is tax free, and then you pay a capital gains tax above that amount. Um, I think that people would think it's very unreasonable to tax the entire gain here. Just like income tax, we have a basic exemption, approximately 14,000 almost, right? So I think they'd have to look at that. I also think people would say, well, hold on a second. In the US, when they tax your principal residence, they also allow a deduction for mortgage interest. And I can guarantee you 100%, I would be comfortable predicting there's no way that the government of Canada will allow a deduction for mortgage interest if they tax. So I don't think it's going to happen. I know some people are nervous about it, but I just don't see it happening. But you never know. You never know. But I think they'd have to make an exemption amount. I think there'd be a rebellion and they would lose the next election if they tried that. But who knows? I don't know.
Gerry, what do you think?
Yeah, I'm with Neal 100%. Political suicide if they go near it. I think they actually will. And I agree with what Neal's saying, that you got to have a good exemption. So I'd even say your first $1 million, or maybe even 1.5 million, is exempt. Like, leave the little property owner alone. Go after the people who are making a fortune on their properties. And I don't think anybody would, I don't think that would be as politically damaging if they gave a good exemption. I'd minimum would be $1 million. Yeah. I also think this might be the time that they attack what I've been concerned about for almost 40 years, which is when we file a personal tax return, we say, those of us that operate businesses out of the home, we go business use of home. And since I started in this game, I'm like, oh, that's interesting. We're just telling the government we use 15% of our house for business. And for 40 years now, I've been wondering why the government doesn't, why do we get our tax-free principal residence when we're telling the government year after year after year, we use 15% of this thing for business. So I see them going after that. I know for my clients, I never use that form on the personal tax return. I never fill out that stuff that says, oh, how many square feet is your house? What percentage is business? I don't go near that form at all. I still claim the same deduction. There's nothing preventing me from going on an Excel spreadsheet, calculating the same amount, taking whatever that number is and plopping it into office expense. At least we're not telling the government that we're using 15, 20% of our house for business, because I think maybe now is the time they might go after that. So that's a concern.
I think also, like my wife and I, we live in Thornhill, we rent out our basement, and I claim the rental income, and I claim a certain percentage of my house expenses, and they allow, it's on the CRA website, it doesn't jeopardize your principal residence if you rent out, a small part of your house, you haven't made structural changes. But because I claim a basement rental, I never claim home office. I've been working from home for 8 years. This is my Seinfeld shrine. I have George on there. I have Kramer. I work from here, but I never claim a home office expense, because if you claim a home office expense and you rent out your basement, then you could be jeopardizing the principal residence exemption. I'd just like to add one more point about the idea of taxing principal residence. And really, this applies to capital gains in general. This is what bothers me about the capital gains tax. I understand why we tax capital gains, but in a certain sense, when if you've owned your house for 30 years and then you sell it, is it even really a gain, or is it just inflation? And inflation itself is a hidden tax. And now you're taxing inflation. So there's I think that's why I agree with Gerry. They have to put in a big exemption amount, or else you're really just taxing inflation, and it would be really unfair. Now, just because it would be unfair and not make any sense doesn't mean they won't do it. But I think there has to be that big exemption amount, because people will not stand for taxing an inflationary paper gain, right? And I've also heard some people say maybe they'll only tax the principal residence sale if you've been in the house for less than 5 years or less than 10 years, something like that. So if it's like kind of more short term, but if you've been there 20 years, then they don't tax it, something like that. So who knows what they'll do if they do it. I don't know.
Okay.
Just want to jump into, I was going to comment the same thing, Neil. I think they might introduce something that says, your capital gains, your principal residence exemption applies after so long of a certain period of ownership. So, if you live in your house for 2 years, all of a sudden this principal residence exemption kicks in. And if you're going to move around and try to take advantage of these principal residence exemptions. So I don't think that would be too much of a surprise if they challenge that.
Yeah.
Also, I want to mention, it's funny you mentioned the renting out of the basement. Once again, as I mentioned with the office and home form that's on the personal tax return that people are familiar with, there's also the rental income form that's on the personal tax return. Correct me if I'm wrong, but it's my understanding we have to report the income, but we don't need to use that form to do it. So if we use the rental form, we're just saying, hey, I'm renting out my basement, 50% personal use, 50% rental use. Once again, I think that's something they could attack.
Yeah.
We could go take that same information, put it on an Excel spreadsheet, find out what our net number is, and just put that number into our business or income, or that would track CPP, but just as other income. So I'm a little weary of using these prescribed forms that they have always wanted us to use. So.
Yeah.
Okay, Gerry and Neal, thanks both of you very much for taking the time. I know it's a busy time of year. We appreciate the time. I would encourage you all, if you have questions, don't hesitate to reach out directly to Gerry or Neal. I've posted their phone numbers. If you're looking for a mortgage, whether you're first-time buyer, move-up buyer, self-employed, we have mortgages, no tax returns, no notice of assessments required. Investors with any number of properties, retirees, people with credit issues, construction mortgages, land, commercial, private, whatever the case, give me a call. So you've got all of our phone numbers there. We did our best to get to all of the questions. Neal has posted his website there, grumpyaccountant.ca. Gerry's website is canadianinvestmentservices.com. Right, Gerry?
Yeah, .com or .ca. Thank you.
.ca. Thanks everybody for joining us. Next week at this time, Gerry and I are doing a session on mortgage investing and RSPs. We're going to have a guest from a MIC, Mortgage Investment Corporation. He'll be on the line. We'll talk about pros and cons of mortgage investing as a passive investment. That's next week. The week after, what happens if your deal doesn't close? If you're a realtor, that's something that could be on your mind. People have overpaid in some cases for properties. What's the implication? We'll have lawyer Bob Aaron and real estate agent Barry Lebo on. And the week after that, I'm doing an evening session on how to sell more real estate with creative financing, or how to achieve your real estate goals sooner. That's in an evening session. I'll be playing my guitar. Bring your own booze. That's on May 5th. Okay, so thanks everybody for joining. We did our best to get to all the questions. Don't hesitate to reach out to the guys directly, and we'll see you next time. Have a wonderful day, everybody. Ciao.
Thanks.
Bye.
Thank you.
Good day.